Now let's bring in another voice, Joe Saluzzi from Themis Trading, man who knows more about order flow and markets than pretty much anybody out there. Joe, welcome. And I want to be very careful with this story, okay? And you understand why. We're talking about one share available to purchase on Robinhood, which is also a broker and has capital requirements. When you see a big platform like a Robinhood make this rather extreme move, what might it possibly tell us about what's going on behind the scenes?
Well, hey, Brian, great talking to you. It's been a while, right? But I think it's clearly, obviously, everybody knows that there's issues here. They have problems. I think what Kate just pointed out about the self-clearing is very interesting. You don't find many retail brokers who are self-clearing. That obviously adds a whole level of risk and capital requirements. It doesn't mean they can't get out of this. It means they need to seem to settle their books. And I think the bigger issue for them is when it comes to public relations. This is not a good look. They're obviously very irate customers. I've seen them all on Twitter complaining. But, I mean, what they're trying to do is save their firm, it seems like. They're trying to make sure that they're in regulatory compliance, and they're also making sure that they have enough capital.
And again, I want to be careful on this, but just from a PR perspective, maybe I'm not going to ask you to dive into the financials because we don't know. We don't know them, except that they did raise capital last night. They went on the air and said basically they didn't need to, and then they did, but that they were doing it in a proactive way. Do you think Robinhood, as a platform, is at risk?
I don't know. Like you said, I don't know what's inside there. I do know they have a PR problem. And what I do also know is this is not new. Okay, what's been going on at Robinhood? Last year, if you remember, they got a $65 million fine for the way they're routing orders. And we've taken exception with that many times over the years about the entire payment for order flow system. That in itself, we think, is the crux of the problem of what's been going on over the last week.
Yes, and without getting too much in the weeds, Joe, this is a big issue. And we're realizing now that Robinhood, which says, okay, we're for the little guy and we're going to be free. You have to ask yourself, how is it free? It's not free. It's not. They're being paid when we place orders on Robinhood. They're being paid largely by Citadel Securities or others who buy that order flow from them. What we have learned about Robinhood is that they may be for the little guy or say they are, but they are not the little guy. There are billions of dollars on both sides of this. Is there not?
Yes, and by the way, they're obviously not the only retail firm, accepting payment for order flow from the market makers for those orders. But what's interesting about Robinhood, by the way, is as far as I can tell, based on the FINRA filings, they're not a member of any stock exchange. They only route orders to market makers, so they need those market makers to accept the flow from their clients. Market makers, of course, will say that they're offering price improvement, and they're also going to pay for that flow. But we think the problem with payment for order flow, and again, this is not just Robinhood, it distorts the order routing process. It takes that order, that retail order, which should be interacting with the diverse pool of other orders in the market, institutional, pension funds, and so on, and it intercepts them at the market maker level. The market maker, those orders never see the light of day. They never go to a stock exchange. The market makers take them and then basically can model other behavior, which is the reason why they pay for it. They model the behavior of the market, not just necessarily that trader. But that distorts pricing, in our opinion. The true price discovery process is when you get all of those orders interacting in a diverse environment and they work with each other. So payment for order flow is a distortive price process. Robinhood and other retail firms figured out a way to say, hey, we'll take that money. Hey, we're going to offer zero commissions for you guys. It's free. But they've made hundreds of millions of dollars last year in payment for order flow. And that's their business model. But if you don't understand that, you have to read into their filings. Now, whether or not that affects your trading, you know, they do offer price improvement, the market makers. They will tell you that. We offer price improvement. But at what cost? How far is the spread? You know, what's going on? There's all sorts of other questions that we don't want to get into the deep weeds right now.
Yeah. Yeah, well, I would say that being able to maybe only buy one share would be an impact on many of their customers, to your point, many of whom, of course, were irate. The two founders were, or maybe still are, considered billionaires, a lot of money at stake. Joe Saluzzi, always appreciate your point of view. Thank you very much.
Thanks, Brian.
Shepard Smith here. Thanks for watching CNBC on YouTube.